Hey everyone, and welcome back to the Why Machine. Today, we're not just looking at numbers on a screen. We're diving into the very soul of investing. This is more than a list of terms. It's a conversation about the philosophy behind building wealth, understanding value, and navigating the unpredictable waters of the market. Let's get into it. The foundation, building blocks of wealth. Think of every investment journey as a story. Every story needs a hero, and in this case, the hero is the asset. An asset isn't just something you own, it's a resource with economic value that you control. It's something you believe will produce a future benefit. It could be a stock, a piece of real estate, or even intellectual property. It's the very seed from which your financial future will grow. The opposite of this is a liability, something you owe, a debt that pulls resources away from you. The goal, always, is to grow your assets and reduce your liabilities. One of the most fundamental concepts in the stock market is going long. This isn't just a term, it's a mindset. It's the belief that a company, a business, has a bright future. When you go long, you're betting on growth, on a company's ability to innovate and expand. You're buying low with the conviction that you'll be able to sell high later. It's a testament to your faith in the market's ability to reflect true value over time. Valuation, perspective, how do we even begin to measure that value? That's where tools like the P/E ratio, price to earnings ratio, come in. It's a quick snapshot of a stock's valuation. By dividing the stock's price by its earnings per share, you get an indicator of how much the market is willing to pay for a dollar of that company's earnings. But here's the philosophical catch. This ratio is based on past or projected earnings. It's a glimpse in the rearview mirror, and as we all know, past performance is no guarantee of future results. It's one of the reasons why investing requires more than just looking at numbers. It requires a deep understanding of the story behind the company. Speaking of stories, a company's story is often told through its financial statements. The balance sheet is one of the most important chapters. It's a financial snapshot, a moment in time that shows a company's assets, liabilities, and shareholder equity. It's a powerful tool that helps you understand what a company owns versus what it owes, painting a picture of its financial health. This leads us to the concept of intrinsic value. This isn't about what the market says a stock is worth today. It's what you, after doing your homework, believe the asset is truly worth. It's the philosophical anchor of value investing, a strategy championed by legends like Warren Buffett. Value investors believe the market is emotional and often misprices assets. They seek out these hidden gems, businesses trading for less than their true worth. This is in stark contrast to growth investing, which focuses on young, dynamic companies whose earnings are expected to explode. Growth investors are betting on potential, on the future, often accepting a higher price today for the promise of a bigger payoff tomorrow. The nature of market mechanics. The market is a constantly moving conversation, a dynamic dance of supply and demand. The bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller is willing to accept. The gap between them is the bid-ask spread, a small but crucial piece of the market's engine that must be bridged for a transaction to occur. Sometimes, the market gets carried away. This brings us to the efficient market hypothesis, a fascinating idea that suggests all available information is already reflected in a stock's price. If this is true, then consistently beating the market is impossible. While this theory is debated, it serves as a powerful reminder that the market is a complex, information-rich environment. It's a humbling thought, isn't it? In a world where information is power, insider trading is the ultimate transgression. It's the illegal act of trading based on information that isn't available to the public. It violates the core principle of a fair and level playing field, undermining the very trust that the market is built on. Strategies. The passage of time. Time is perhaps the most powerful force in investing. This is the realm of compound interest, which isn't just a mathematical formula. It's the quiet, relentless force that turns small sums into fortunes. It's the process of earning interest on your original investment and on the accumulated interest from previous periods. Over time, this creates a snowball effect that is truly astonishing. It's a testament to the power of patience and consistency. For those looking to manage risk over time, dollar-cost averaging is a wise strategy. Instead of trying to time the market, you invest a fixed amount of money at regular intervals. This removes emotion from the equation and smooths out the impact of market volatility, ensuring you buy more shares when prices are low and fewer when they are high. For those with a more active approach, there are different rhythms of trading. Day trading is a sprint, a high-stakes strategy where you buy and sell within the same day, seeking to profit from minor price fluctuations. It's intense and requires a deep understanding of market trends and a strong stomach. Swing trading, on the other hand, is a marathon, with trades that last from a few days to a few months. It's about catching the swing of a price move. And what about those who don't want to pick individual stocks at all? That's where ETFs, exchange-traded funds, and mutual funds shine. These are baskets of stocks that allow you to diversify your portfolio instantly. An index fund, a type of ETF or mutual fund, is designed to simply track a market index, like the S&P 500. This is a brilliant, low-cost way to bet on the overall growth of the market itself. It's the ultimate set-it-and-forget-it strategy for long-term growth. Remember, investing is a journey of self-discovery, a constant dance between analysis and intuition. It's about understanding the concepts we've discussed and applying them with discipline and a long-term vision. It's not about getting rich quick. It's about a mindful and deliberate process of wealth creation. If you found this video insightful and feel like you learned something new, hit that like button and share this with a friend who's curious about investing. And of course, for more deep dives into the why behind money, markets, and life, be sure to subscribe to The Why Machine. Until next time, keep asking the big questions.